you're live.
Thank you.
You're welcome.
Good afternoon, everyone. Delegate Derek Davis. This is the House Economic Matters Committee. We'd like to take this opportunity to welcome everyone before the House Economic Matters Committee today for an update on foreclosures, excuse me, during the COVID-19 briefing, COVID-19 pandemic. This briefing, we'd like to start by thanking our illustrious Attorney General, Brian Frost, who's going to come and give us an update from his office. That will be followed by an update from the Department of Labor, then the Department of Housing and Community Development. We will also hear from the Maryland Bankers Association, and finally, we will close with Maryland Legal Aid. So without further ado, welcome, Mr. Attorney General.
Thank you very much, Mr. Chairman and members. It's a pleasure to be with you. With respect to foreclosures in Maryland, there's some good news and some bad news. The good news is that right now, there are very few foreclosures in our state and have been since the governor's executive order in April. And the reason there are few foreclosures is there are two moratoriums or moratoria in effect. One is a state moratorium where the governor has instructed the Commission of Financial Regulation to stop receiving and processing notices of intent to foreclose, which are a precondition to an action for foreclosure. And when he issued that executive order in April, cases that had already been filed could continue or have continued to a limited extent, but it turned off the spigot. And so, there are very few cases that are being that are in process right now. The bad news is that, as everyone knows, we're in the middle of the COVID-19 pandemic. People are losing jobs, they're losing income, they're having difficulty paying the rent, paying the mortgage. The hardship has fallen, as I'm sure you all know, most heavily on poor people, on people of color. The Black and brown members of our society have been hardest. People who make less than $20 an hour have, on average, 15% unemployment. People who are making more than $20 an hour have 3 to 5% unemployment. So I think it's fair to say that renters are more hard hit than homeowners, but homeowners are going to be very hard hit when the moratoriums end. The federal moratorium is a moratorium on mortgages that are backed by federal agencies, insured by FHA, by U.S. Department of Agriculture, by the VA, by Freddie Mac or Fannie Mae. And although we don't have a clear number on how many mortgages that is, it's probably somewhere around 50% of the mortgages nationally and in Maryland. But I haven't been able to find any definitive explanation of that. I'll come back to our Access to Justice Task Force in a couple of minutes, but I thought it would be useful to show you some statistics that we've compiled that show you the impact of the pandemic on not just foreclosures, but on foreclosures and evictions. So if we could go to the next slide, there's some of these, so the eviction moratorium, there was a national eviction moratorium that ended at the end of July. We still have, the governor has provided tenants an affirmative defense to eviction cases. And basically, if they can go into court and prove that their income has been impacted by the COVID-19 crisis because they lost a job, their hours are reduced, they're taking care of a loved one, don't have daycare for their kids, whatever, they can stay in eviction proceeding. So cases dropped, they're starting to rise, and we anticipate that they're going to rise dramatically throughout the rest of this year and into next year. Next slide. This is failure to pay rent, filings, warrants, and evictions. You can see they dropped pretty significantly starting in April and running through the end of July. And as I say, they're going to pick up. Next slide. So these are foreclosure notices. They fell off. The blue line is the notice of foreclosure. The brown line, tan line, is notices of intent to foreclose. And the notices of intent ended with the governor's order in April. There were some cases that had been filed previously. As they work their way through the courts, they're ending. Next slide, please. So again, this is the Maryland Volunteer Legal Services caseload in effect, and you can see, and this is sorted by race. So you can tell that Black folks are having by far the hardest time, but the intakes for foreclosures have dropped precipitously because you can't proceed with foreclosures at this point. Next slide, please. Here's, this is very jumbled, but it's significant in this respect. These are folks who go to the People's Law Library and look up, do legal research on their own. And what you see is through February of 2020, they were kind of constant. These are different questions that people are looking at. They're kind of constant. And then in February, they really spike in a couple of important areas, mostly in terms of eviction questions. But other folks who are visiting that website doing legal research for other topics, that's also beginning to go up. And this is only through, I think, the beginning of the end of August, perhaps. Next slide, please. Maryland legal aid housing intake. This would be for both foreclosures and evictions. And you can see the top line, by the way, are African Americans. And they've always been harder hit in terms of housing and needed more help from legal aid. And you can see that in April, things started to rise, because while there is sort of a moratorium in effect, people know they're in trouble. They can't pay the rent, and they're going to legal aid and seeking help. Next slide, please. Can we go to the next one? Okay, this is just a small claims dashboard. Just shows you that in 2019, there were more small claims filings because we have some debt collection restrictions in effect in Maryland, but they will be lifted, and you'll see a huge rise in that as well. Next slide, please. And here, same thing. Debt collection intakes from legal services has dropped way down because the restrictions on filing debt collection actions that have been in effect until recently. Next slide. Again, same thing for consumer debt. you can see, and these are broken down by race as well, but debt collection cases have fallen in the spring. They're beginning to rise. They're beginning to rise now. Next slide, please. This is a completely different subject, but thought it might be of interest to you. This is this shows you internet connectivity and speeds throughout the state. And the green areas are the areas where things are pretty good. And you can see in sort of the core of the state, in the middle of Maryland, pretty good. As you reach out into the rural areas, it gets very, very sketchy. Speeds slow down, coverage is poor, and that obviously impacts people's ability to work remotely, and of course, the ability of their kids to learn from school if school isn't open and kids are trying to learn via computer. Next slide, please. Another significant issue that I think will not surprise you, and that is the requests for protective orders and peace officers and peace orders increased dramatically as the pandemic has worn on. This is the brown or tan line is this year, 2019. You can see it goes up and down, but fairly stable. This year, it went down as the pandemic hit, and then really started to spike in May and June. It's tapered off a little bit since then. Next slide, please. And the People's Law Library is, you can see, getting inquiries about domestic violence issues starting to increase in the spring, and probably will continue upwards as people continue to be sort of confined even while they're having disagreements. Next slide, please. So this is the website from which you can take a closer look at all of the pieces of information that we just went through. It's broken down by race, sometimes broken down by geography, and again, it shows that poor people, people of color, are being hit disproportionately hard. Now, we have an access to justice task force that we put together to address the issues, and in part to make recommendations to you, figure out how to address what we see as a continuing healthcare crisis that is hurting the economy, hurting people's ability to pay the rent, pay the mortgage. And among the recommendations that we are considering, I think it's tomorrow, will be several on housing. One in particular will be raising the state exemption for money that people can keep when they go into bankruptcy and lose their home. Right now, it's $26,000. That's among the lowest in the country. And I suspect the task force will be recommending an increase in that. Our office has been deeply concerned, and you'll hear from legal aid in a few minutes, but we've been deeply concerned about access to legal services for people who don't have resources but face these daunting issues like losing their homes. Legal aid, legal services has been funded in our state by interest on lawyers' trust accounts. Well, banks ain't paying interest anymore to speak of. It's negligible. And they've been funded by court filings. There's a surcharge on the court filings that goes to legal aid. And both have fallen off a cliff. The court filings, as you saw among those charts, are down for evictions, foreclosures. And that has blown a hole in the budget for legal services all across the state. Our office won a settlement from a residential mortgage-backed securities case. It was Deutsche Bank, I believe, in the started during the financial crisis in 2008. We got a settlement. The proceeds have to be devoted to housing. We were able to pay back the state and the counties for the losses they suffered for the securities they bought, and we had $8.7 million left over. We wrote to Governor Hogan and asked that we be permitted to put that money toward legal aid, toward the Maryland Legal Services Corporation, which funds all the different legal aid agencies in our state. And he said yes. And he added $3 million from general funds. So there is going to be $11.7 million that will fill the hole that has been created for legal services in our state. We're going to have to find a long-term solution for that, because this 11.7 million bucks is not going to last indefinitely. And the two normal sources for that fund legal aid are going to be questionable for some time. So I expect that we'll be asking you, the General Assembly, to find another source of income for legal services. For the time being, I think we have solved a short-term problem. Let's put it that way. I think they were on the verge of having to cut funds and cut jobs without these new funds. So I think that's very timely. And people have asked, why didn't you just put that to rental assistance? And the answer is, we think there is a force multiplier by putting it to legal services. We couldn't make much of a dent in the deficit in rent payments that are owed. And we think that's really more than 100 million, probably hundreds of millions of dollars by the end of the year, by the beginning of next year. But there are lots of people who can go to see one lawyer in the course of several months. And the lawyers at Legal Aid, Legal Services are very good at helping folks find solutions to their legal problems and stay in their homes. So we thought that was the most cost-effective means of delivering aid to these folks who are literally having crises over where they're going to sleep at night. Mr. Chairman, that concludes everything that I was prepared to say. I'd be delighted to answer questions if you have them.
Thank you so much, Mr. Attorney General. Are there any questions? And you guys know how I am with this technology stuff, so hit the chat or something so I can find you if you do. Of course, Delegate Wilson won't follow the order, but I saw his hand. Delegate Wilson, turn your mic on.
Thank you, Mr. Chairman. Thank you, Mr. Attorney General. One of the questions I have, it's very brief, is just about, as we're moving forward with these foreclosures, we have the dual cycle of the renters not being able to pay, and therefore the business owners or the building owners not being able to pay their mortgage. How close is that tied in, and what are we looking as an out? How are we going to solve that problem? Because I know a lot of this stuff is just being basically forbearance, and the balloon payments are not going to come for the renters, they're not going to come for the mortgage holders. What as in your professional opinion do you see as a possible out for us as a state to ensure that we don't have another housing crisis where we have all these houses on the market, or all these buildings, commercial or otherwise, on the market, and no feasible way of upkeep?
You you nailed it, Delegate Wilson. I mean, that is the biggest problem we face. If a tenant has been out of work since April and not paying the rent and not being evicted because they have a COVID-19 defense or because the straight up moratorium was in effect for several months, there's no way they're going to be able to go back, get a job retroactively, earn the money to pay the rent for all those months that they're behind. The Access to Justice Task Force had recommended to the governor that he devote about $135 million to rent assistance out of the CARES Act money that the state received. We thought that would serve both purposes that you identified. Number one, it would allow the tenants to pay rent. Number two, the money would go to the landlords and they could use it to pay their mortgages. At the time we made the request, only about 400 million of the 2.4 billion had been accounted for. We understand that the rest of the money has been spent. So assuming that to be true, that means the only hope we have is that there is a stimulus package from Congress that enables folks to get out from under this problem. And when I say folks, I mean both tenants and landlords. But it's not something we can fix with legal aid. It's not something we can fix with a one-time rent payment. It's a very serious economic problem.
And I just want to follow up briefly, Mr. Chair. My worry also becomes with some of our business owners who are renting, and I want to make sure that we do something that extends that renter protection to our business owners because they're not able to open up. Some have been forcibly shuttered, and I've seen this happen. I've had to help a few of them out legally because they're forcibly shuttered, yet they're moving towards foreclosure on these businesses. And I understand that the lien holder has obligations as well. But I hope that as we move forward, whatever the solution we can find, that we also do something to protect our small businesses who are behind on their rent, because unfortunately, many of them were government forced to shutter and they're suffering. They're trying to keep their employees. But I just hope that we keep that in mind as we move forward on a solution that includes them as well.
Yeah, I completely agree.
Thank you.
Is there anyone else?
I see Delegate Walker waving his hand.
Delegate Walker. Mike.
All right, can you hear me now? Sorry.
Yep.
All right. I just wanted to, I know that Delegate Wilson talked about the renters and everything else, but I'm really concerned about homeowners. So what do we do about homeowners that have these payments coming? And I've mentioned this before, you weren't on the call. How do we give them some protection? They were furloughed from their jobs and some of them had good jobs, but if they face these balloon payments that the mortgage companies are placing on them, what can we do? Like, is it something that I think the simple solution would be force the banks, and I know we got bankers on there, to say, you know what, this person had 72 months on their loan, now it's going to be 75 months. You tack on those 3 months that they were getting assistance on there. But how do we assure that that can happen? Can we help it happen? What do we need to do? Because I really see that's going to happen, and that could, if we allow these foreclosures to take place, then we're looking at another foreclosure crisis.
We are. I mean, I think you're right. We're looking at a housing crisis across the board, and foreclosures for residential mortgages are a big part of it. It's tough for the state without just, appropriating money for that. Federal government has a lot more leverage. They lend the banks money, they insure mortgages, they securitize mortgages, and they can negotiate with the banks in ways that an individual or a state cannot. And there may be some small things that we can do in Maryland, but we run into constitutional issues like interference with contracts. And so I'm afraid that the biggest piece of that solution is one that's in the hands of the US government, President and the Congress.
So if we take the money that we're talking about, the assistance money that the state can have to help out, what could we do to work along with the banks to make sure that it's going to help relieve some of the things we can't control because of the federal guidelines? Like, coming up with a X amount of dollars and saying people get it if you have a job. We don't know if that's really helping, but if we're worried about them having shelter and what can happen,
Right.
then is there something that, I don't know if it goes to your office or whose ever office can go through to help with this pure mortgage assistance? And can your office also, maybe you can help out, can your office look into it? Because I'm big on, well, if the banks have received any type of federal help at all, then they should be willing to have a trickle-down effect to people that are their clients, their customers, consumers. And I'm really curious about that.
Yeah, I mean, that certainly is something that Congress can do. There are all kinds of federal programs, federal aid, and to a lesser extent, there are state programs. The Department of Housing and Community Development plays a role in assisting banks in placing mortgages, making mortgages, et cetera. And we have contracts with banks at the state level. We don't have nearly the leverage that the federal government has, but we have some leverage. And we can say, look, you want to do business with us? We want you to set up programs that allow for not just forbearance for a month or two, but instead of having a balloon payment in 4 months or 6 months, we want you to put it at the back of the mortgage. You're going to take a little haircut because you'll have lost the interest on it for this period of time, perhaps. But instead of the mortgage ending in 17 years, now it's going to end in 18 years or 19 years. And the payments are going to remain the same, but they'll get tacked on at the end of the mortgage. And
Can we put something in there in our state law in Maryland saying that, you know what, we're not going to allow balloon payments to come under extreme circumstances or conditions? Is there something we can do legislatively to prevent that?
Let me say this. We'll work with you to try to find a solution like that. There are certainly ways in which we can't do it. There is the Constitution prohibits interference with private contracts, and mortgages are contracts. But I think there may be ways of getting to that end without just saying you're prohibited from enforcing your contract.
Well, please reach out to my office. Chairman Davis, I'll sign up to be on that. Just let us know. We got to do something.
Okay. Yeah, I definitely wanted to put that to Bob too, because I'm curious. If we could do something like that, it would probably be with state chartered banks. I'm curious, would we be preempted from that sort of mandate on federally chartered banks, which probably have 90% of the mortgages, but I could be completely wrong as well. So I was gonna ask that question. I'm curious as, do we have, I guess for lack of a better way to put it, standing for most of the banks?
Well, Mr. Chairman, I mean, one way we can definitely make a difference is to condition participation in state programs where we put state monies on cooperation from banks in a certain way. And I think those are things that we should be looking at.
Fair enough. Anyone else for the Attorney General before we let him get on with his day? If not, thank you very much, sir. Appreciate your time.
Thank you. It's a pleasure to be with you, Mr. Chairman, members. Good to see you all.
Welcome, welcome. All right, guys, at this point, we're going to move on to the Maryland Department of Labor. If Ms. Meredith Merchant, the Director of Financial Education and Community Outreach, if she can join us at this point in time, welcome. Or is she not with us?
She's on mute.
Oh, we gotta unmute ourselves.
There she goes.
Heyo.
There we
Yeah,
go.
can y'all hear me now?
Yes,
My
we can.
apologies. All right. Okay. Thank you for having me. I am the Director of Financial Education for the Office of the Commissioner of Financial Regulation. I will be speaking today on behalf of Commissioner Salazar. The Commissioner sends his regrets that he couldn't be here. He had a longstanding commitment this afternoon with the chair of the FDIC. So next slide. We were asked to speak on the current state of foreclosures in Maryland from the perspective of the department. So I will be reviewing the current protections and COVID relief for homeowners facing foreclosure, and we'll share some of our most recent data. I will also be describing some of the things that our office is doing to assist Marylanders during this time. Next slide. The Office of the Commissioner of Financial Regulation is Maryland's state banking and financial services regulatory agency. We supervise the businesses and individuals providing mortgage services to Maryland consumers. We have a number of ways that we obtain information about regulated businesses. We conduct examinations and investigations, including investigating complaints from Maryland consumers and reviewing various reports and filings. We engage other state and federal regulators and law enforcement agencies, and we have ongoing communication with industry sources and state and local consumer advocacy groups. Next slide. So in addition to other financial services businesses, the Commissioner has regulatory authority over state chartered banks and state chartered credit unions, as well as non-bank entities, such as mortgage lenders and mortgage servicers. The majority of the entities supervised by us are also subject to regulation at the federal level through agencies such as the U.S. Department of Housing and Urban Development and the Federal Housing Finance Agency. Next slide. You can move on to the next slide, please.
I think we're having technical difficulties.
All right. Well, I'll keep talking then for the sake of time. So in April of this year, Governor Hogan issued an executive order that included a foreclosure moratorium. This order prohibits the initiation of residential foreclosures by suspending the notice of intent to foreclose electronic system, and Attorney General Frosch touched on this. The notice of intent to foreclose system is an online portal through which mortgage holders or servicers submit electronic copies of notices of intent to foreclose, or NOIs, to our office, and this is required by state law. An NOI, for those who may not know, is basically a warning notice that is sent to a borrower if they have fallen behind on payments or defaulted on their mortgage in some other way. The NOI must be sent to the borrower at least 45 days before the foreclosure action can be filed in court. Note that the governor's order is not superseded by the lifting of the stay on foreclosure cases by the Maryland Court of Appeals. The lifting of this stay just allows foreclosures that were already filed to proceed and allows foreclosures that could have been filed prior to the stay to go ahead as well. And also there is a foreclosure moratorium, as you all are probably aware, on federally backed mortgages through the end of the year. Okay, next slide. With respect to evictions related to residential foreclosures, the governor's moratorium on evictions due to COVID-19 remains in effect, and this is issued through executive order. There is also a federal eviction moratorium for federally backed loans through the end of the year. Next slide. Okay, so this slide shows some of the same data that we saw in the previous presentation. This is foreclosure data from the foreclosure reporting and registration systems that is managed by our office. The blue bars indicate the NOI. Prior to the pandemic, monthly NOI submissions were at some of the lowest levels that we've seen since the NOI requirement became law. You can see that no NOIs have been received by us since early April, because that's when the governor's order went into effect, shutting down the system. The orange bars are for the notice of foreclosure, NOF. The NOF is submitted to our office within 7 days of the first court filing. Consistent with what, so this number should reflect the number of new foreclosure cases filed in court. So consistent with what we would expect to see with the moratorium in place, the NOF numbers are down about 2/3 from pre-pandemic levels. Next slide. This is some delinquency and foreclosure data. These are the delinquency and foreclosure rates in Maryland since January of this year. The green bar is the rate of delinquency, and the yellow bar is the rate of foreclosure. The delinquency data does include loans that are currently in forbearance. So you can see that for August, the delinquency rate in Maryland was 8.6%. This is a little higher than the national rate for that month, which was 6.9%. And the foreclosure rate for our state, again, was 0.4, and this is slightly higher than the national foreclosure rate for August, which was 0.3. Okay, next slide. So our office's response so far. We've done a number of things to respond to some of the distress caused by the pandemic. And first and most importantly, we remain open and available to any Maryland consumer with a question, concern, or the need to file a complaint against a mortgage lender or servicer. The commissioner and department worked with the governor's office to bring about a number of voluntary forbearance agreements from some of Maryland's banks and lenders that are holding non-CARES Act eligible loans. We've also issued a number of advisories to industries and businesses we regulate about the new COVID-19 financial protections for consumers, and we're prepared to issue another advisory clarifying that the governor's order regarding the foreclosure moratorium is still in effect. Okay, next slide. We've created a financial relief resource guide for Maryland residents. This includes an explanation of the mortgage relief and foreclosure protections, as well as how to contact our office and other regulatory or consumer protection agencies. We've been in continual contact with community nonprofits, housing counseling agencies, legal service providers, and other consumer advocacy groups. To date, we've done 6 webinars for consumers and practitioners on the newest financial relief options. We've also been in continual contact with federal regulatory partners and industry representatives. Our office is also an active participant in a multi-state regulatory network. This allows us to coordinate nationally the monitoring and supervision of the mortgage servicers' forbearance plans and foreclosure activity. Next slide. So moving forward, we will continue to do all the activities I just mentioned. We will continue to monitor mortgage lenders and servicers to ensure that proper forbearance options are offered to the borrowers. There is compliance with the foreclosure moratorium, and there is compliance with the existing mortgage servicing standards and rules. The monitoring will be done through examinations and investigations, the state and federal partnerships, regular communication with the court, and outreach to Maryland consumers and the groups that represent them. We will take appropriate action if we identify violations. Next slide. So just a quick reminder, the mortgage relief provisions are still in effect under the CARES Act and through various rules enacted by the federal agencies. A consumer with a federally backed loan may request forbearance for up to 1 year, as you guys were discussing. Okay, next slide. Okay, so the loan flow is not covered under CARES Act or any of the other federal protections. The agreements that the governor and our office helped to secure from many of Maryland's lenders and servicers have terms similar to the CARES Act. The bottom line is that borrowers should contact their mortgage lender and servicer now if they are experiencing difficulty meeting their payments or expect to have difficulty meeting their payments so that they can discuss their options. Next slide. So just a few final thoughts. The governor and other state and federal leaders have been pushing for more economic stimulus, as you know. We're hopeful that this will happen soon because that will bring more immediate financial relief to consumers. On top of that, Maryland's economy was relatively strong part of the pandemic, and generally speaking, we appear to be on the upswing, a trend which should help homeowners recover. But in the meantime, mortgage lenders and servicers, they have a better compliance management, better customer communication, and better internal infrastructure in place now than in the previous crisis. There's been a lot of lessons learned. Our office, as I mentioned, is an active participant in a really strong regulatory network that monitors the lenders and servicers and enforces consumer protections. And as discussed earlier, our office has a number of tools and resources at our disposal for supervising the mortgage holders and protecting Maryland homeowners. And we are prepared to use them. Next slide. So these are links to some information on our website, the COVID-19 resource web pages, a foreclosure data tracker, which is where the data, the NOI and NOF data is. We update that weekly. And the previously mentioned financial relief resource guide is also on our website. Okay, next slide. So here's our contact information, and thank you for your time. Hopefully I can answer any questions you all may have.
Thank you very much. We very much appreciate your presentation. Are there any questions?
Yes, Mr. Chairman Ben.
Delegate Brooks.
Thank you. Thanks, Meredith, for your presentation. Quick question. What are the consequences for non-compliance or violation of the governor's moratorium by a mortgage company?
So, well, it hasn't happened, and it would be up to the commissioner's discretion depending on the severity and what the circumstances are around the violation. We'd have to investigate and see what happened. So it's kind of hard to answer that. Just generally speaking, our office, for any violation or you know, like when we investigated consumer complaints and we uncover a violation, it could be a number of things. You know, if it's overcharging of fees, then we require the fees to be reimbursed, or we may, we can issue cease and desist orders. I mean, there's really a broader way of tools. So when it comes to violation of the foreclosure moratorium, I can't really say because that hasn't happened yet. If you want a more specific answer, I can certainly bring that back to the commissioner.
Okay, yeah, because I was sort of looking at it to see what position that the company would take, because there was a deed of trust, that the borrower signed off on. So whether or not which one would carry the most weight. So just curious. Thanks for your answer.
Yeah. The Attorney General's office may have some jurisdiction as well, for sure.
Okay, all right.
Is there anyone else? Delegate Jackson.
Yes, hi, thanks, Mr. Chair. I don't know if this was covered, but what happens to students who signed lease agreements for, let's say, a Towson University, and the Towson, the university is shut down, so they don't want to stay on campus. They kind of want to go back home. Are we doing anything about that, or can we?
Yeah, so just to clarify, our office, we supervise the mortgage companies, promulgate regulations around the foreclosure process, joint authority with the AG's office to enforce certain protections. We don't have any role in the landlord-tenant relationship or any regulatory authority over rental housing. So I defer to the other panelists or local jurisdictions would maybe even answer that.
Okay. I think, if I'm not mistaken, that would be under environment and transportation. Don't they handle real property over there? I think that's Delegate Jackson. I think that would be the committee of jurisdiction for, and I think I know what you're talking about. I read about that at the University of Maryland. So I think I know the scenario you're describing.
Okay.
You can look into that to see what's been done, or I'm sure that there have been a number of complaints that have come in on that. Anyone else? If not, thank you very much. I appreciate your time and your presentation.
Thank you.
And yes, now we'll move on to the Department of Housing and Community Development. We will hear from Matthew Heckles, the Assistant Secretary and Director of the Community Development Administration, and I believe Mr. J. Hunter Pickles, Director of Legislative and Federal Affairs, Housing Policy Office, will be joining him. Welcome, gentlemen.
Thank you. Thank you very much. And thank you, Chairman Davis and members of the committee. I appreciate the opportunity to be here today. We've done several presentations on eviction prevention. This is the first one focused specifically on home ownership and foreclosures. So it's nice to bring up that discussion. From the outset, I would point out that the Department of Housing and Community Development, unlike the Commissioner of Financial Regulation, is not a regulatory agency. We're actually the state's housing finance agency and are ourselves a lender. Assistant Secretary Matt Heckles is the director of the Community Development Administration, which oversees our single family lending. And so I'll let him get into a little more of the specifics on the Maryland Mortgage Program, which is our mortgage product. But that said, I think the Attorney General and the Office of Commissioner of Financial Regulation have pretty well covered a lot of the issues that we're seeing, the various moratoria and protections that are in place on the state and federal levels. I think the governor's prohibition on initiation of foreclosures at the end of the day trumps most of the other protections, so long as you can't initiate the foreclosure, then a prohibition on further action is sort of superseded. And that's been in place since fairly early in the pandemic. And that executive order is in place until the state of emergency and the catastrophic public health emergency are lifted. So we have some strong protections there. I think one of the things that was touched on, I'll go into a little bit more. The CARES Act passed in March provides a right to forbearance for individuals with federally backed mortgages. It's an initial 180-day right to forbearance for someone who's suffered a financial hardship. And then that can be renewed again for another 180 days upon request of the borrower. And so effectively that means that anyone with a federally backed mortgage who has a financial need is able to essentially defer their payments for up to a year. So we'll see, barring additional federal legislation, we'll see that start to expire in March, April of next year. One of the things that was brought up is the amount of mortgages or percentage of mortgages that are federally backed, and that's about 70%. So 70% of mortgages in the marketplace are covered by CARES Act provisions. The remaining 30% are either held on the borrower's books or are held as private label securities. And actually, interestingly enough, one of the things that that was out there, the mortgage bankers put out recently a study on some of the breakdown of what the forbearance rates look like by type, and the non-CARES Act covered mortgages actually have a higher rate of forbearance than the CARES Act covered mortgages. And that kind of jives with what we've seen from the industry. Lenders, even as they're necessarily required to, have been offering forbearance to their borrowers during these times. So that's promising. Also, kind of anecdotally to address Delegate Walker's question about balloon payments, what we've seen and heard is that most lenders are not applying balloon payments. They are tacking it on to the end of the mortgages in general, although I think the bankers could probably get into that a little bit more. And so with all of these protections in place, what we've seen is that people have availed themselves of these opportunities afforded. And the foreclosure homeownership has taken kind of back burner to eviction issues, which is it was brought up by the Attorney General also. And there's been significant infusion of capital to the state and local governments for eviction prevention, homelessness services, rental assistance types of functions. From HUD directly across 3 programs, there's been about $125 million that has flowed to the state or local jurisdictions. And that's in addition to whatever allocations they would have received from the coronavirus relief funds. Some jurisdictions used coronavirus relief funds. The governor put up some coronavirus relief funds for our agency to administer an eviction prevention rental assistance program. And some local jurisdictions have also put up their own cash. So there is a significant amount of investment that has already gone to try to protect renters as well. So I guess in conclusion, I would just say that right now, the outlook in the housing market, at least the homeownership market, is fairly stable, and there are some positive indicators. But as with all of the pandemic policies that have been put in place and that we're still exploring, we'll have to kind of stay on top of what things look like as these protections start to unwind. And that will be in coming months. So with that, I would turn it over to Assistant Secretary Heckles.
Good afternoon, Chairman Davis and members of the committee. Let me know if you can't hear me. I think the testimony so far has been really fantastic. The Attorney General, Meredith and Hunter, I think adding some points. I really don't have a whole lot to say on the potential foreclosure and default side of the mortgage market. I'll take maybe a few moments just to give you a little sense of the home buying market. I think it is good news, and especially as it relates to the Maryland Mortgage Program. MMP is the Maryland Mortgage Program is operated by the Community Development Administration within the department. over the last several years, we've really focused on this program. It is the way that the state finances first-time home buyers with down payment assistance and low interest rates. And so we have taken that program from a program that provided assistance to the tune of about $300 or $400 million a year to over $1 billion last year. And we've done this by focusing on our partnerships with lenders and realtors, as well as making sure that we had really good products on the street for home buyers, and making sure that we're doing good marketing and providing the best products we can. So that's nearly 5,000 families that we assisted last year, and so that was a high watermark for the program. We're pleased that as we've entered into this pandemic phase, the markets were really, really shaky for the first few months. There was a lot of uncertainty, but they've really stabilized. In fact, through that early part of the pandemic and its impacts, and when the market was so upset by the circumstances, the Maryland Mortgage Program was a stabilizing factor, and we really provided a source of liquidity and mortgage financing to the mortgage bankers and lenders in the state of Maryland, and we were very happy that the Maryland Mortgage Program could fulfill that role, as there was so much uncertainty. Rates before the pandemic were, of course, very low. I'm sure, been following the news, and they have remained low and fallen. We have hit record lows for qualified first-time home buyers in the Maryland Mortgage Program. Last week, we hit a low rate of 2 1/8 on the 30-year fixed-rate mortgage, which is I started talking to my staff and kind of jokingly said, at some point, is this irresponsible? It's such a low rate and a great opportunity for people to finance long-term debt and buy a house. The Maryland Mortgage Program also offers down payment assistance. So we're really trying to break down barriers for first-time home buyers. Primarily, the Maryland Mortgage Program overperforms in serving households of color and other demographic groups that can sometimes be have a lower home ownership rate, and we're very proud of that record. But the mixture of very low income rates, as well as a really low supply of homes for sale on the market, has led to some increase in home prices. That makes it difficult, even more difficult, for people to access home ownership, and another reason why it's really important for the Maryland Mortgage Program to be so focused on expanding its availability to the clients that we serve. That increase in home ownership, in home values, is I think a really critical part. I'm jumping back maybe a little bit towards the foreclosure and delinquency topic, but one of the main differences that we'll see, to the extent that we enter into a phase where we're looking at mortgage delinquencies down the road, home values should maintain themselves through going forward. There is still strong demand and not enough supply on the market, and so we should see home prices stay high. That's something that didn't happen in the 2007 and 8 and 9 timeframe, when we were dealing with the financial crisis. And as someone who worked a lot on programs through that process, through that time, that was the primary issue. You had borrowers who were stuck in homes that they couldn't get out of, and in this case, we're still seeing a very high amount of demand, very low supply, and increasing prices that should alleviate and give options for homeowners moving forward. Just one more comment on the forbearance side. Maryland Mortgage Program has been tracking forbearance requests and delinquency requests of our past borrowers, and I'm pleased to report that, quite frankly, the Maryland Mortgage Program remains strong. We saw that actually through the financial crisis as well, but MMP borrowers are required to go through a homeownership education or counseling program before they can buy. we have these low interest rates. We give people down payment assistance that can help them to keep a reserve in place. So in general, MMP borrowers are strong. We are making sure that our financial picture is strong as we move forward to make sure that we're ready for any potential issues. But right now, the Maryland Mortgage Program and its borrowers are seeing very low rates of borrower stress. Our servicers that we work with are reporting that in general, the first 6 months of forbearance has started to expire. And so the prediction is that we will start to see a decrease in the number of forbearances, active forbearances, as those homeowners do not extend that first 6-month period moving forward, even though they have an opportunity for another 6-month period. And they will either enter into resume their mortgage payments or enter into some sort of workout plan after this first 6-month period. And some borrowers, of course, will continue on in the forbearance programs for the next 6 months. A lot can happen between now and then, but as Hunter said, we're really looking at the unwinding of that forbearance program in March and April, and starting to discuss how we will be ready. I think that I'm a member of the Attorney General's Access to Justice Task Force. That group has done a lot of work on both the eviction and now turning a little bit more towards the mortgage topics. But the $11.7 million that the Attorney General announced with the governor a couple of weeks ago is going to be a tremendous amount of help for people. That leveraging factor that the Attorney General talked about, I think, is very true. We have a lot of funding that Hunter discussed coming in to help with renter assistance on the homeownership side. I think that it still remains to be seen, but in short, I think that the can was kicked down the road with the forbearance programs. And we aren't quite to the end of that road yet, but it is time for us to start thinking about what that unwinding looks like. Thank you very much. Happy to answer any questions you may have.
Are there any questions? Am I missing anybody? If not, Hunter and Matthew, thank you so much for your time. We definitely appreciate it and all that you guys are doing. So thank you very much.
Thank you.
And at this time, we will go to the Bankers Association with Mindy Laban, the Senior Vice President of Government Relations and Communications, and General Counsel Robert N. Welcome, folks.
Good afternoon, everybody. If your permission, I'll lead off, Mr. Chairman. Let me say that we have the Maryland Bankers Association has been extremely proactive in dealing with this issue. As you heard from the statistics and as you saw in the charts, basically the foreclosures were shut down pretty much completely in the state of Maryland on April the 3rd when the governor issued his executive order. You can't file a residential foreclosure in the state of Maryland unless you can send and file a notice of intent to foreclose with the Commissioner of Financial Regulation. You've been unable to do that since April the 3rd. In addition, and that notice has to be sent 45 days before you file. In addition, under Maryland law, you can't initiate a foreclosure until the loan's been in default for at least 120 days. The average length of time before COVID to go through from a date of default to date of ratification of foreclosure was 545 days, almost a year and a half to get through a foreclosure case on average. What you've also got at the same time, as you heard, is you've got federal law, which as the gentleman from HCD said, applies to 70% of the mortgages in the state of Maryland, that require the lender to offer 2 180-day forbearance periods. And the FHFA, which regulates the secondary market, has also now required that you can't add a balloon to the mortgage, that you've got to put the the amount that was the forbearance on the tail end of the mortgage. So what's interesting to me is, typically when members of the General Assembly have a problem, a constituent problem that deals with a bank, that deals with a mortgage, they reach out to the Maryland Bankers Association. We've not had a single contact from any member of the Maryland General Assembly since you adjourned, saying that they had a constituent that was having a problem, a foreclosure problem. Now, the last thing that any lender wants to do is to foreclose. We don't want to take possession of these properties, and the process takes forever. So our banks, our members, are bending over backwards and will continue to do so to work with borrowers that are having difficulty making payments. Under the CARES Act, all the borrower needs to do is certify that he can't pay because of COVID, and he's entitled to the forbearance. That's all it takes. For the most part, I think, as you heard, lenders that are not subject to the CARES Act are complying with the provisions of the CARES Act voluntarily, or even going beyond that to help borrowers. We feel like we've got a pretty good handle on this, and the governor's order. If you look at whether it's bowling alleys or racetracks or bars, restaurants, whatever, the governor's eased back almost all of his orders. One thing he hasn't eased back an inch is the foreclosure moratorium that we have in the state. So the state of Maryland seems to be is in sync with the federal government. This is an issue that everyone's concerned about. We feel like we're working with it, and we'll continue to work with it. And Mindy has, we've got slides that we're happy to share with you, and resources. And we had there's a joint committee on ending homelessness, and they had a briefing. I think it was on Tuesday, where we made the presentation, and they asked for the slides because the slides have links to them for you all to be able to share with your constituents to get help. And if you have any questions, any concerns, any issues whatsoever, please reach out to Maryland Bankers Association, to Ms. Lehman, or myself, and we'll be happy to work with you and put you in touch with whoever we need to put you in touch with to get it resolved. So with that, Mr. Chairman, I'll turn it over to Ms. Lehman. Thank you.
Thanks, Bob.
Great. Thank you. Should I go ahead and proceed, Mr. Chairman?
Please.
Great. Thank you. And I'll take you through our PowerPoint, and our presentation is very consistent with what you've seen before us. So I'll try not to spend much time duplicating information. So let's go ahead and advance. And of course, the focus of our presentation today, as Mr. Enton just covered, is the industry response, the mortgage payment relief options, which you've already heard a great deal about, and then again, the foreclosure at the federal and state level on evictions and foreclosures. So let's go ahead and advance. So in terms of MBA's outreach and the Maryland Bankers industry outreach, we have been, as Mr. Enton said, very proactive on this, getting out that message with the media. If you have any concerns about your finances, be it your residential mortgage loan, your business loan, call your banker. They are there to help. We have been in daily calls with our national and other state banking associations. This isn't happening in a vacuum, so we're staying very close with that. We're also in regular contact with both the Maryland Commissioner of Financial Regulation as well as the federal regulators on this. We have been in close contact with you all at the state level, and then also our congressional representatives. And then we set up an online resource for banks and customers off a COVID resource. If we could advance a slide. Here you go. So you and or your constituents are very welcome to visit this. It's got some great information on it. So let's move forward, please. Okay, so this slide provides an overview of the different types of relief that Maryland banks are providing on a regular basis to their customers. There's loan payment deferrals, as we talked about. There's forbearance. There's also interest rate reduction, fee waivers, increases in lines of credit for those who need it, consumer loans, consultation, and more. I was talking with one of my member banks earlier this week, and as Mr. Pickles and Mr. Heckles talked about, one of the bright spots in this has been the housing market and the low mortgage rates. And my banker told me that they have been doing easily double to triple the amount of refinances in this low interest rate environment. And that's also providing relief to homeowners in a very positive way. So let's move forward. Okay, and then this is just a repeat of the CARES forbearance provisions that are out there. And then I'll draw your attention to the in caps at the end, which clearly state, and this is coming from the FHFA, that no lump sum will be required at the end of the forbearance. As we've talked about, a common way that works well for customers is to just extend those payments onto the back end of their mortgage. If they prefer to address that in an alternative way, that is something that they can work on with their servicer. And really the goal is to find the best financial solution for the individual borrower. So let's move forward. Okay, and this, I won't repeat this because we've spent some time talking about the foreclosure and eviction moratoriums at both the federal and the state level. I will draw your attention to these links that are at the bottom of the slide. So the FHFA has some really helpful links, as well as the Consumer Financial Protection Bureau. And these are very customer-friendly information resources, including videos. If you have constituents who aren't sure if they've got a federally backed loan, there are links on those sites that will provide them easy access to that information. So let's go ahead and advance. Okay, we talked about this, so let's move forward. This is the state level foreclosure protections. And then here are some additional links. So if you have constituents who are concerned about their student loan payments, for example, if you have folks who still haven't gotten their stimulus payments and they're not sure where they are, there are links to all of that. So this slide is a nice resource landing page for that information. So let's move forward. Okay, and then we talked about this earlier, which was the governor's announcement on April 3rd with a number of Maryland lenders that are providing all of these. And I would say the vast majority of lenders across the state are doing this, whether they're a part of this formal announcement or not. Let's go forward, please. And that is the end of our presentation. So I'm happy to answer any questions.
Mindy, just so I'm clear, and I think you're pretty clear, but I want to make it crystal clear because it was in response to Delegate Walker's question about being able to tack on, let's say if I'm 3 months or 6 months behind, being able to call your lender, I think you're using the term forbearance, and being able to just tack, as opposed to trying to come up, like if you're 6 months behind of a $2,500 a month loan, that's $15,000. And that may be difficult to come up with even on a 2-year or whatever the agreement is. So am I hearing correctly that they are in fact just allowing, let's say if my mortgage was scheduled to end July 1 of 2021, it would just get pushed back 6 months to maybe January 1 of 2022? Is that kind of scenario part of the mix where you just tack it on at the back end?
Yes, sir, that's correct. Now, if the borrower chooses to take an alternative approach, for example, if they'd rather not have that all tacked on to the end and have a later, date, they can arrange for a different payment that suits their specific needs. But you are absolutely correct.
Okay. I don't know if Delegate Walker is still with us, but we'll definitely share that with him. Delegate Wilson. Mike.
Thank you, Mr. Chair. We're just looking up the mute. Ma'am, two questions I had. The first one, when we talk about the forbearance, you heard Mr. Chairman ask about tacking that onto the back end. Is that, do they have to go through all the paperwork of a refinance, or is that just an agreement? How is that done?
I could weigh in, Delegate. It's done with an agreement between the lender or the mortgage loan servicer and the borrower. It's not like a refinance at all. This
So
is
there's
what
no
we're
credit
doing.
check
This is
or
what
anything
we've
like
been
that?
doing. Nothing, none of that at all.
Okay, and secondly, when we talk about that year forbearance, are they obviously they're being told that the interest is still going to be calculated, correct? And there's still going to be accruing interest for all that time that they're
Sure,
not.
but they don't have to make any payments. That's
I do agree, but basically the amount they owe will be increasing instead of decreasing or staying the same while they're in forbearance. Since there is interest accruing on that loan, the amount that they owe at the end of the year of not paying will actually be increasing, correct?
I have to sit down and think a little bit about how that would work. If you don't have to make payments, I guess you're continuing to interest continues. I guess the amount of interest you owe goes down, of course, as you make payments based on what's attributed to principal. So if you're in forbearance and you don't have to make any payments, I guess you're the interest, whatever the percentage is, and if it's 3 or 4 or 5%, I don't think there are many interest rates out there that are probably at this point above 4%, and they're much lower now. Then interest is continuing to accrue, and you're not making any payments against it. Let me say that I'll bounce that question and get some more information for you, get back to you about just how that works.
Because to my understanding, Bob, and from the research I've done, is obviously basically if you go into a year forbearance, the amount that you owe will increase and possibly substantially depending on the percentage of points that you have on your loan. And that would be my fear as individuals doing this, not being aware that they're actually going to be owing a lot more, or sometimes depending on the nature of the loan, a good amount more at the end of that year. And I understand sometimes that they can't help it, but I just want to make sure that that's fully disclosed if I'm right. I know for college loans, they punish you for a forbearance, and I know I'm being punished now. So in the little research I've done, I assume it's the same for low housing loans as well. I just want to make sure that that's something that's being taken under consideration when these individuals enter these agreements. Thank you.
Thank you. We'll look into it.
Let me go to. Oh, I'm sorry. Go ahead.
Okay, no, thank you for the question, Delegate Wilson. And you raised a good point about the credit rating. So I did want to mention that the CARES Act does specifically say that if you enter forbearance under the CARES Act, that will not be negatively reflected on your credit rating. In addition, it says that no additional fees, penalties, and additional interest are all prohibitive. So we need to trace down your question. But I did want to make that clarity in terms of, if there were concerns about additional interest or fees and penalties, that's prohibited.
And Delegate Wilson, I talked to the people about your student loan. That's just for you. That's nobody else. Let's go to Delegate Charkoudian, and then Delegate Chi wanted to ask you, Mrs. Lehman, to go back a slide. I think she had a question on the slide, so we'll go to. We'll go to Delegate Charkoudian, Delegate Chi, and then Delegate Brooks, if he still had a question.
Thank you, Mr. Chair. So I want to just ask a couple more questions about this issue of the lump sum payment and what specifically the CARES Act restricts, because I'm hearing you say that in general, what you expect or what's sort of in the mix is adding the forbearance of the year to the end of the mortgage. There's still this question that Delegate Wilson has that I also eagerly await the answer to. Is there inadvertently more additional costs to the borrower if we go forward with that? But what you had on the screen a moment ago said no lump sum payment at the end. It didn't say that it automatically is a longer term for the payment. And so the way that I read no lump sum payment is technically a bank could be in compliance with no lump sum payment by increasing the monthly payment, but not extending the time that the mortgage ends. And I want to check in on that. I'm hearing that, like, obviously the ideal is, and some of the banks are offering this extension of time, but I'm not seeing from what you put up here that that's what the CARES Act requires. And so I just want to understand what the bank's options actually are in your understanding of the CARES Act.
My understanding is, and I'm happy to, to get back with you and provide you documentation. I hope I'm right. My understanding is that at the borrower's option, the amount of the forbearance gets as Delegate Chairman indicated. If your mortgage would normally have run through, September 1st, 2021, and you missed, 12 payments. Now your mortgage is going to run through September, of 22. That's my understanding at the borrower's option, that's what happens.
Okay, but no lump sum payments doesn't mean that. So I just want to make sure we're clear, because if we choose, if that's not what the CARES Act says, then we may want to do something additional in Maryland that would require that that's an option for the borrower. So
okay, we'll get back. I mean, once again, that is my understanding. I think when they talk about lump sum, I think the concern is that at the end of the forbearance period, okay, you didn't pay for a year and your payments were $1,000 a month. Now give me $12,000. That's my understanding of,
right.
Of what the lump sum means. Clearly that is not happening.
That's not happening, but what is between extend the mortgage and lump sum is the possibility that it's now you have to pay $200 more a month for the next 10 years to pay it off. And that may be a hardship for some people. So I want to make sure that in between point is not on the table.
I think that my understanding is that that's at the borrower's election.
Okay, well, let's follow up on that. The second question is related to the credit report. Again, what you had on the screen was that during the forbearance period, there couldn't be a credit report, but I'm just wondering if there's a credit reporting that could occur after the forbearance period that's tied to the fact that the person requested the forbearance. So does that question make sense?
I believe I understand your question. And the forbearance is treated because a forbearance is a pause in the mortgage payment. So you're not making your payments during that forbearance. So typically that would be looked at by the regulators as a delinquency. Right. And of course, with the CARES Act, they've addressed that issue so that it is not reported as a part of your negative, as a negative credit rating. So once the borrower comes out of forbearance, if they return they will return to the agreed upon arrangement, and that can be just extending the amount of the loan, which we just talked about, and that would not be negatively reported. So I hope that answers your question. Yeah. So if they should come out of forbearance and not make mortgage payments, or if they're not paying potentially other bills that in an ordinary sense would be negatively reflected on a credit reporting, that would indeed be a possibility. Okay. But under the forbearance, with the regulatory attention that's been given to it, they are recognizing that not as a negative, it will not be negatively reflected.
Okay. I have one final question, which is sort of following up on Delegate Walker's question from earlier, and the benefits that the Maryland banks received from managing the PPP loans. Do you know how much in the way of PPP loans the Maryland banks managed, and how many of them kept the funds on the fees, and how much in the way of fees they were able to keep as a result of that?
I don't know anything specific about the fees. Now, the fee rates were embedded within the PPP program structure itself. So that's a very specific parameters. In Maryland, 87 1,000 loans, PPP loans were made for a total of $10 billion. So, and that ended up supporting about 1 million jobs across the state. So it really, the program had a remarkable impact, and that was put together in partnership, of course, with the Treasury and the SBA. And it was something that banks worked hand in hand with businesses to get that rolled out in a very quick pace. But I don't know specifics about the fee question that you're asking. Okay. I do know, I mean, that I can pull that, I can go back and pull that amount for you in terms of the amount.
Yeah, that'd be great, because I think I would agree that it's a fantastic program. There's a lot of businesses in my community that benefited from it. But as we're looking at how do we deal with the pain, and how do we deal with the fact that there are constituents, you know, especially low-income constituents, who have been really devastated by this pandemic, we're also looking at who sort of has been able to benefit. And the PPP loans were essentially the federal government's money, so banks didn't have to put any of their own assets at risk in that lending process. And they were still able to have recoup fees and interest rates without putting any of their own assets at risk. And those interest rates went beyond just the cost of managing that loan. So I just think when we're going back, we've been talking about this in terms of utilities as well. Like, how do we spread the you know, who's paying for this, you know, these challenging times? How do we spread that across everybody? You know, when we have to make some difficult decisions. And so I think that context is a helpful context to have as we're figuring out if we're going to put additional restrictions on banks in order to make sure that you know, we're not we're kind of dealing with the pain in our communities.
Yeah, I appreciate your perspective, and all of the bankers that I have talked to, none of them did this for the financial benefit in terms of participating in the PPP loan. They had to stand up significant systems, both internally. They had people working literally round the clock to process these. It was a very significant undertaking. And then, of course, what we will cycle through next is the loan forgiveness process of this. And we're expecting that to tick up around December. So that will, again, be a significant undertaking, but it was one that they were incredibly supportive of. They saw the need for the Maryland businesses and wanted to make sure they were a partner in helping meet those needs. But I have not had one member say to me, well, this has really been a financial boon to us. I mean, they really point to it as a positive that they were able to roll this program out and work so closely with the businesses to get them the financial assistance that they need. And you're absolutely right. It's intended to be a grant program so that the benefiting businesses ultimately will not have to repay that loan.
Yeah. And I'm glad we did it too in the state. I'm glad we had it, but I don't think that we can ignore the fact that the banks did receive an income from it with beyond the cost to the banks of managing it, and that income was not from putting their own assets at risk, because the assets involved with the federal government's. Sure. But I would be interested to know what those fees amounted to. There's been some national press on it. I'd be interested to know what the Maryland amount is. Thank you, Mr. Chair.
Yeah.
Delegate Chi.
Thank you, Mr. Chair. I actually have a question not related to mortgage as much as just small business assistance for MBA. At the beginning of the pandemic, I did reach out to MBA and asked if there was a way for us to make sure there could be some deferral of interest payments for small businesses that owe debt or borrowed, you know, some loans from banks. And there was a gap of time between what they had to pay back, which was often beginning of the month, and the PPP loan that was rolled out eventually, you know. And I was basically told, you know, we would be proactive, encourage your constituents to reach out to us, and we'll figure out some way. And so it would be like a case by case basis, right? So now, all these months later, we have learned a lot of lessons. I would like to know, you know, what kind of assistance do we have in place for small businesses? If you have mentioned it, I didn't catch it. No.
Yeah, and that's a great question. And I think it continues to be a case by case addressed case by case. So that way you can make sure that you're best meeting and helping that business the way that it's needed. And many businesses benefited from the PPP loan, but that's not the end of the assistance that's been available and will continue to be available. So Maryland banks have been working with their business customers, if they need forbearance, they're working with them on that. If they need to skip a payment, for example. And I've talked to several of my bankers, which they mentioned that at the beginning of the COVID crisis, they had extended forbearance to approximately 25% of their business portfolio. But then half of those businesses did not come back for another 90 days of deferral. So fortunately, those businesses were able to see improved economic conditions where they did not need another round of forbearance. Now, if the business needs another round of forbearance, then the bank will absolutely work with them. So we are later in that pandemic cycle. However, the support is not going away. But again, and you really hit on it. The key is continuing to communicate with your banker as you're going through this so that you can best assess where you need that assistance. Is it a skip of payment? Is it a loan modification? Is it a longer extension of forbearance?
Yeah, and on that note, if you could just elaborate a little bit, like some of the creative solutions you were able to come up with to give me and our legislative colleagues an idea. Let's say if we referred a small business that was in desperate need of cash and can't pay back loan and want a deferral of interest, what would be, what would you say to that person? Are you saying there's like 100 different solutions? Or what are the patterns of solutions you have resorted to that have been working for you or for them?
Yeah. And I would recommend that they reach out directly to their banker. It's sort of hard to come up with a one size fits all for that. And if we could, there is a slide early on in my presentation. Let's see what page it is, that provides a nice snapshot of different tools that are in the tool chest. So that could be, as we talked about, loan payment deferrals. It can be forbearance or modifications. It could be an interest rate reduction. There can be fee waivers. If that business needs a line of credit increase to help it, perhaps there's, they see the light at the end of the tunnel. So what they're looking at is more of a stopgap of perhaps bridging a 2-month period. Then it may be that the best solution for them is an increased line of credit to get them through that hurdle, or another line of credit. It could be a consumer loan. It could be sitting down with that business with a fine-tooth comb to go through their financials and consulting with them on what their options are. So there's a lot of tools out there, and it's a matter of, and I've been hearing from our members that they are absolutely going through their portfolio and proactively working and reaching out to their business customers so that they can get a jump start on this. So they're tackling it on the forefront of it in a proactive way versus several months down the line where your options become fewer because you're in really financial distress. So I hope that helps answer your question.
Yes, I just wonder if we could have a comprehensive summary of what you have actually done and what has worked, like what kind of clients resorted to what kind of solutions. If there's a way to do that, that would be great to have like a summary overview. That's it. Thank you.
Sure. And I'd be happy to, also facilitate a conversation with you and some of our member bankers, and then that might provide for a more robust exchange of information. If you're interested in that, I'd be very happy to follow up.
Thank you.
Certainly.
Delegate Brooks.
Thank you, Mr. Chair. I guess I've got more of a comment of perhaps in reference to Delegate Wilson's question and talking about that whether or not the mortgage balance is going to increase. Normally, when we got a mortgage, we got two things. We got the principal and we got the interest. And as that principal balance, you pay on what we call the declining principal balance. And as that principal balance decreases, that's the less amount of interest you pay. If the principal balance does not decrease because of forbearance or whatever, that means at the end, the amount of interest you pay will definitely increase. So in essence, the homeowner or the taxpayer would definitely be paying more in the long run, not increasing the principal balance, but at the same time, increasing the amount of interest that is paid on that loan. So, all right. Thanks, Mr. Chair.
Is there anyone else? Delegate Turner.
I just want to ask Mindy, can we get, how can I get a copy of your presentation? Kind of, Mindy, can I have that? Did you have it down there for me to contact you? What was that? Did you have a contact number? I mean, email?
Sure. So my email is mlayman, which is my last name, LEHMAN @mdbankers.com. So it's mlayman @mdbankers.com. And the committee staff also has a copy of my presentation. If you're interested in that, I'm happy to send it to you directly as well.
Oh, I don't think
We'll make sure you get it, Delegate Turner.
Yeah, I didn't get it on my paper. I'm sorry.
We'll make sure you have it.
Thank you.
Anyone else? If not, Robert, Mindy, thank you so much for your time as always. We certainly appreciate it. It was very helpful. And we're going to move on to our final presentation of the day. It is from Maryland Legal Aid, Mr. Anthony H. Davis II, Director of Advocacy for Consumer Law.
Thank you. Thank you very much, Delegate. Members of the committee, thank you very much for having me and having this discussion. Can everyone hear me okay?
Yes.
Yes, okay, thank you. Listening to the presenters before me, I agree with a great deal of what was presented, agree in terms of what we've been seeing. And at Maryland Legal Aid, as part of my duties, I supervise a foreclosure legal assistance project. If we could turn to the next slide. So at Maryland Legal Aid, what we do is we provide free civil legal services to individuals in Maryland. These individuals have to meet financial requirements, eligibility requirements. So for example, a household of 4 cannot earn more than roughly about $32,000. So we deal with that segment of the population. Anything more than that, and there are many more people affected by these events than low-income individuals. But my presentation will really be concerned about what I am seeing and what we are experiencing representing low-income individuals in the state. Next slide, please. So just a little bit about our program, our project. So in 2011, the Maryland homeowners were given a right to request a foreclosure mediation. This was an amendment in the statutes. And in response to that, Maryland Legal Aid created this special task force. Now our task force operates statewide. We're in 12 offices across the state, 23 counties I think are represented. And when we created this task force, this foreclosure legal assistance project that we call FLAT, we were initially funded by Legal Services Corporation, Maryland Legal Services, and a lot of the money that was generated from the foreclosure settlements with the bank. Next slide, please. So the type of representation that we provide and that we have been providing to homeowners during this time of this pandemic is really a full service legal representation. If the homeowner is in serious default, they don't necessarily need to have received a notice of intent to foreclose, but you miss 3 or 4 mortgage payments, the writing's kind of on the wall. And what can you do? Initially, when we received funding, it was to provide representation for homeowners at the mediations as they're trying to work out some type of agreement, some type of assistance with their lender, who's represented by counsel. We would represent the homeowner as well. But we also represent the homeowner at any instance within that state court proceeding, that foreclosure action that's filed, trying to do our best to preserve home ownership at all stages, and work with the lender to help the homeowner stay in their home. And that may look like reinstatement, trying to work out some kind of payment arrangement. Loan modification is the principal resource that we have. We also file a number of bankruptcy cases, and we're not the only legal service provider that is representing people in foreclosure, but I do believe we are the only one that is providing Chapter 13 bankruptcy protection, which really just helps you kind of reorganize your finances and helps you to pay off the arrears that you've generated and keep current on your payments. And that's not an easy thing to do. It's not easy to maintain your regular payments that you have missed for several months or several years, and also make an additional payment towards the debt that you've incurred. We also defend against any allegations of predatory lending, lender abuse, property tax issues, HOAs, and such. Next slide, please. Again, I spoke about who's eligible for our services. We represent a low-income population. Because of certain funding requirements, most of our people that we represent are at 125% of federal poverty guidelines. That's that family of four earning about $32,000 or so. But there are other programs that we have that make it, that it stretches the financial guidelines, kind of allows a little bit more money to be made. And also there are programs that we have that, depending on certain circumstances, finances are not an issue. This is a 60+ program in some counties, and these are people who have been victims of abuse or asylum seekers and such. So there are other ways that you can qualify, and it's not just a financial determination. Next slide, please. And again, our clients, we can go next slide. Our clients are pretty much across the state, and we have 12 offices serving these individuals. Next slide, please. So here's where we get into what I think the panel really wants to look at. It was what have we been seeing during COVID-19, during the start of the pandemic, and what have we been doing presently? So before the pandemic, certainly there was foreclosure, and certainly there were low-income individuals. And when you're at the low end of the income totem pole, before a pandemic, any type of emergency, and we've never seen anything like this in our lifetime, but any type of emergency can just wreak havoc, be a catastrophe for you. It doesn't have to be what we're experiencing now. It could be just simply be someone falls ill, or, job loss, your hours are cut. I mean, if you're making these amounts, that could really have serious effect on you and your ability to pay your mortgages and your regular living expenses. So we certainly were seeing issues before, nothing to do with COVID. Before the pandemic, I calculated we had 93 new client intakes. And let me also add, in the last few years, our numbers as far as new client intakes have been going down, because I think the general consensus is foreclosure itself, the crisis that we experienced some years ago, had been kind of going away. It's been getting better. We have been seeing less and less foreclosures, less and less clients coming to us. During the pandemic, as many people have talked about, there were suspensions of court proceedings in place and moratorium in place, and that really helped a lot of people. That's really been our saving grace, not just for clients who have been affected by COVID-related issues that affect their finances, but just people who are already in the mix of foreclosure. There were cases filed prior to COVID. There were people dealing with these issues before. And when the moratorium came in place, it stopped all of that. And we hadn't served many clients, the clients that we served, certainly those numbers, I believe the Attorney General showed the graph, the intake numbers went down significantly. And only now, only in about maybe since end of August, have we been seeing an uptick in those numbers. During the period between, let's say, April 3rd and the end of August, what we've really been doing is really helping clients navigate all the new orders that have been sent out, court orders, industry-wide, mortgage forbearance, helping them apply for forbearances. And we haven't had any problems. Maybe in the beginning, it was just kind of confusing for everybody on both sides of the table. But we hadn't had issues where we had a problem with a mortgage banker or mortgage lender not offering a forbearance. Quite the opposite. We've had situations where they've reached out to our clients. Every website that we go on, a mortgage company, there's always a link to if you're experiencing hardship and such. So to the extent, how has the mortgage moratorium and forbearance operated for our clients? As smooth as you can put a transition, we've been able to really get a lot of assistance for our client. There has not been issues where we have been denied the relief that we've sought. We've also been still able to apply for loan modifications for those people who have been in the works. We've received loan modifications for clients, so they've avoided foreclosures. We've also been denied, but the denials are not COVID-19 related or any way in violation of what's been put out, the moratoriums that's been put out. It's simply a matter of income. And that's really the problem that we are looking at going for the future. There are protections in the CARES Act. Some of the questions that were asked about what's going to happen as far as, if you're paying additional interest, if you are, once you come out of it, these things, what's happening in, as far as our clients are concerned, we don't know what the future will bring. Pretty much everyone is thinking about the present. But as things start to lift and we start to see a request for how are you going to work out these payments, the issues that we're running into are really not that lenders aren't providing us with options, because there are options out there. It's really that these clients have lost income that's not coming back, have lost jobs that aren't coming back, and they're not in a position to pay what they normally paid. A lot of the relief that we're talking about, and can I have the next slide, please? A lot of the relief, so this is where we're concerned. Okay, during the pandemic, it's been as much as possible smooth sailing. We've been advising clients, we've been helping clients achieve these forbearances, and we haven't had issues. There've been no new foreclosure filings. Since the certain lifting of a moratorium have happened, there's still some in place. There are some foreclosures that have been allowed to go forward. They are not federally backed. They are private investors. These were cases that were filed prior to the pandemic. When you want to file a foreclosure action or continue with a foreclosure action, the court does require you to file a declaration showing that you are exempt from any of the moratoriums or protections in place. It's not an easy thing to find out if the loan is still under federal protection, not on our end. We rely on the lender to provide that information. We do our research, but a lot of times loans have been changed hands so many times, it's hard to keep up. In some instances, we have questioned a declaration that purports to be exempt from the moratorium, and we haven't had any, the issue hasn't been addressed as of yet. But we have asked for foreclosure cases that are moving forward to be suspended, to look at the exemptions, to really provide the information to show us that this is a loan that is not under protection. And for the most part, by and large, this information has to be included anyway. Again, we're just doing our zealous representation of our clients, trying to protect as many people as we can. The question of what happens when the forbearance ends, if it's a federally backed loan, there is literature, there are mortgage letters out there that speak to what will happen. And I agree that everything that we've been seeing, everything that we've read says that lenders will not require, and I'm talking federally backed loans, lenders will not require a lump sum payment at the end of forbearance. That's all the commentary that we have, all the information that we have. There's a CARES Act forbearance fact sheet that is available, and that talks about what certain government loans will do. All of them say there's not a lump sum payment that is required. What is expected to happen is that the amount of payments, the forbearance payment that has accumulated will be put at the end of the loan, as everyone has been saying. There's some programs, as I note in this slide here, the extend modification, where this option seeks to extend the loan term to equal the amount of forbearance. So if you've missed, let's say you've been in forbearance and you availed yourself of the entire year, 12 months of forbearance, so you're extending the loan term to add another year onto your mortgage. Okay. The COVID-19 standalone partial claim, I believe this is available in FHA federally backed loans, where this is a zero interest, no fee, junior lien that has been placed on the mortgage that, again, doesn't, zero interest, so, nothing's accumulating there. And it's not due until you either refinance, you pay off your mortgage, or you sell your home, okay? This isn't available to everyone, as I understand. It's only available to borrowers who are either current when the pandemic went into effect, or less than 30 days delinquent as of March 1st, 2020. Now that applies to a number of clients, but when we're dealing with our population, low income individuals, many of them, the majority of them, don't meet this criteria here. So the fear is that there would have been a lump sum payment required. I do have clients who are at the end of their forbearance. We are who are nearing the end of their forbearance. We are in a position of asking for an extension on that forbearance. But the issue has come up of repayment. How does your client propose to pay? And I respond back, what options are available? Now, just yesterday, I read about the CFPB has amended RESPA Regulation X. They had amended it to say, to basically offer services an option, what they call a payment deferral. So generally what would happen is if my client needed assistance, they would submit an application to a lender. That lender is required under Regulation X to review it in a timely fashion, to offer loan assistance programs, any available programs for the borrower. And again, there's a time requirement to get back. They may require additional documentation during this process, and that's a lot of what we do. The new rule basically says that you don't have to, the servicer doesn't have to go through this process of requiring this documentation. They can instead offer a payment deferral. Now, this payment deferral allows a homeowner to resume the regular mortgage payments, and when the forbearance ends, they resume the regular mortgage payments, and the missed mortgage payments, again, we're talking about placing them at the end of the loan. Again, this isn't available for everyone, but what it does, I think it makes it better for the industry to work with my clients in trying to get a solution to what do we do with all of these missed payments that have accumulated during the forbearance period. All of this, I want to say, everything that we're talking about, these different, and it hasn't happened yet. Okay, we're not at the end of the year yet. We're not at the end of most people's forbearance. You can still request additional time. So the deluge of cases that we have been fearing since this whole thing happened, somebody said you're kicking it down the can. It has been kicking the can down the road. It's been kicked down the road, maybe to the end of the year, maybe to about January, early of the year, January, March or so, is when all of this, not a solution, temporary response to things that are happening, not a permanent solution, but when we will see this protection gone and all of this that we're talking about, this proposed putting at the end of the loan, these different repayment plans, we'll see what happens. We'll see if it works. But I think I need to point out that all of these options that we're talking about for the future are really predicated on the homeowner's ability to pay the current mortgage, to resume making payments like they should have been doing before the pandemic hit. And for my clients, and I'm sure it's happened to a lot of people outside our guidelines, they're just jobs that won't come back. There's just income. Small businesses are affected. A lot of them had to close down. Our clients work for those small businesses. And so that's a problem. Other jobs that were available, even driving Uber and such, it's just not there anymore. So I fear, looking forward, that it won't be so much an issue of will the mortgage industry work with clients to try to offer plans and come up with our best solutions. It's really going to be the ability of people to return back to employment, some type of full employment. And I don't know what we do about that. As a lawyer, I don't have solutions for that. Other than talking about that, I believe to say that the pandemic and the economy, they go hand in hand. And until things really start opening up and people really get back to work and being comfortable and such, I don't know what we do about that segment of the population that has really lost the income that they knew, lost it for good. I believe my next slide is really just a closing. And this is just for your clients, constituents who are out there. Maryland Legal Aid is still open to assist clients with their issues, and this is our number. Do online intakes are available, and we'll help as many people as we can. With that, I'll take any questions or comments. Thank you.
Thank you very much. Are there any questions? See, we got the thing before me, so I can't see your faces. So if you have any questions, either put it in the chat or get my attention. Okay, going once, going twice. Mr. Davis, thank you.
Delegate Impalario had a question.
Delegate Impalario.
Yes, for Mr. Davis. Well, from your conversation, it does sound like the banks are doing their best effort to work with you, and that's good news. So I'm glad to hear that. My concern is that these guidelines that you work with someone who makes less than $30,000 a year. So, and of course, my constituents, family of four making $30,000 a year, they're not buying anything, and chances are they don't have a mortgage. So let's say me and my wife are making $120,000 a year. COVID hit, we've lost our jobs, we're reduced down to $40,000 a year. Do we qualify for any assistance from you and your agency to get help with the banks, or, you know?
Certainly. I'll give you the standard lawyer's answer to any question, which is it depends. And okay. Certainly, I kind of brushed through a slide that we had before, but I was just trying to give you an overview of, you know, the majority of our population. If you were, and I don't know, let's say you were 60 plus, and you lived in Harford County, you lived in Anne Arundel County, wherever, you know, Cumberland. There is a program, 60 plus program, and also one of the Title 3B, which allows us to represent that homeowner regardless of income. So that person, so in your example, if that person was 60 plus, they would have representation. And there are other programs and grant specific projects that we have that would allow to represent someone outside of that tight financial restriction. And when we cannot represent, you know, there's good things that happen during this pandemic. And one of the great things that's happened has been all the networks that come together. The Attorney General's Access to Justice Task Force working with the Office of Consumer Financial Regulation. So we've been able to join forces with members of the MSBA, Maryland State Bar Association, to get volunteer attorneys who will help our clients. So generally, when someone is outside of any of our guidelines and our programs, what we do, very similar to Maryland Volunteer Lawyer Services, is that we rely upon pro bono volunteer attorneys to assist that client. And then that's part of many of our grants, to actually go out and actively pursue pro bono attorneys to volunteer. And our networks have increased. So we're really preparing for the date, for what we expect to come.
So let me just, two quick questions. The first one is, that $30,000, is that what I've made over last year, or is that what I'm making right now? How do you determine that 30? And that's what I'm talking about. So you got the guy who's making 120,000, that he's got a family of four, and their salary now has dropped below that $30,000 rate, but it's only dropped for 3 months.
We represent them.
You would, okay, that's good. Secondly, do you have a package of information? So if I call and I'm making $40,000 a year, right? And I call and I'm like, I need help. You say, look, we can't help you, but let us send you this package of information of who you can go and what your other alternatives are. Do you have a package like that? And can you create a package like that to help those people that you're just sending them the information that they need, the websites they need to go to, who they need to contact, rather than them hanging up the phone and still being lost? Because that's my constituents. My constituents would call you and probably not qualify for the help that you have, but you probably have the answers. So is it possible that you can put something like that together?
Yes. Let me say this. Someone calls, they don't qualify financially, and if they're speaking on an intake hotline to someone who's answering the phone and their job is to assess whether or not they qualify, you're right. They're probably just going to get a referral to some other agency or some other resource. To the extent, do we have a packet of information, something tangible that I can give them? We don't. I don't have it, but that can be put together, and that's a great idea. To the person who talks to me or talks to one of our staff who comes through some other way, they can walk in, make a telephone call or such. We advise everybody. So they won't leave with nothing. And I think legal service providers as a whole, we're very conscious and aware of the that circle of just sending someone to one agency and another and another and another. And we don't want to do that. So I think it's a great idea to put something together. We do try to advise and answer the question. We may not be able to take them on for extended services, but yes, I can put something together and provide that.
And I'm glad you have a good working relationship with the banks. That's good news. That's very good. So
Yes,
I'm glad you have a
can,
good working relationship with the banks. That's great news, and I'm very glad to hear that.
I can honestly say I think that everybody's really been working hard, you know, because it's brand new and it's affected on all different levels. But we have.
Thank you for being here.
Any additional questions? Seeing none. Mr. Davis, thank you very much for joining us with your presentation. We found it very informative, very helpful. So thank you for that. And to the members, thank you once again. I know you have a lot going on, but I appreciate you taking time out to join us in this virtual committee hearing. If you have any questions about any of the presentations, how you can get them, telephone numbers, please give the committee office a call. I think they tried to email the stuff while we were talking, for those of you who didn't get it. Delegate Valderrama.
I was just going to say, did I mute? Mr. Chairman, that Laura had sent a message on the chat that all the materials from today's presentations on the MGA website.
Okay, yes, that's the other location as well. It's on the website. I think they mailed it to you directly once Delegate Turner raised some issues, or maybe they just sent it to Delegate Turner. I'm not sure. But whatever the case may be, thank you guys for joining in. As I said, I know you have a lot going on, and I appreciate it. Take good care of yourselves, be safe, and we will be doing this for real before you know it. So take care and have a good evening.